Hi there. Welcome once again to our accounting classroom. And we would have taken some time to look at the topic of published accounts for companies. And we had this example question called Tuff Incorporated, where we demonstrated how to prepare the income statement in a format that is suitable for publication. So now that we would have completed our income statement, we are going to be taking a look at how to prepare a statement of financial position and a statement of changes in equity. Now, we would have had this question here, and we looked through all of this question, and if we look at it, we can see our statement of financial position items such as ordinary shares, share premium, retained earnings, land, delivery vehicles, office machinery. We also have accounts receivable and accounts payable. We have bank and we have cash, and we have a non-current liability called a bank loan. In the additional information, we have our inventory, which is $19,250, our closing inventory. And in our additional information, it also mentioned about office expenses owing at the end of the year, the prepayment for insurance, and we were told to calculate an allowance for doubtful debt, and we would have calculated that allowance. And also we have some taxes that were charged for the year but were not paid, and we were able to calculate depreciation on our delivery vehicles and our office machinery. Now, this question does not ask us to prepare a statement of financial position, but I'm going to use this question to still demonstrate how to prepare a statement of financial position. Now, if you look also in our additional information, there is no mention of dividends to be paid, any transfer to reserves, etc. So therefore, a statement of changes in equity is not required for this question either. However, I just want to mention to you how the statement of changes in equity or retained earnings, because that's the section of it that we're looking at, the retained earnings, how that would be prepared. It would be prepared as normal, how we would have normally prepared it if we were doing one of the other courses we were doing before. And that statement would start with your net profit. Obviously, we would have calculated the taxes here. So it would start with your net profit after taxation, because we've already completed the taxation in the income statement. So it would start with your net profit after taxation. And then we will continue with we will have our net profit after taxation, and to that we will either add our retained earnings from the previous year if it was a profit. If it was a loss, we will subtract our retained earnings from the previous year, and then we will go into subtracting our transfers to the various reserves and the dividends that were paid. And if there was a transfer to general reserve, you would put in your transfer to general reserves. If there was a transfer to, let's say, a fixed asset replacement reserve, you would also include that. And if you had dividends paid, if dividends were paid for the preference shareholders and the ordinary shareholders, instead of entering dividends separately, a dividend for the preference shareholder, the amount for the preference shareholder, and the amount for the ordinary shareholder that was paid, instead of entering those figures separately, what you would do is that you would enter those figures as one figure. So if you wanted me to do a brief demonstration, you would start here with, let's say it was Tuff Tank, so it would be Tuff Tank Incorporated, and you would have your statement of changes in equity, and that will be for the year ended 30th of June 2016. And you will start with your, as I said, your net profit after taxation, because we would have already done our taxes already. And that net profit would be what we would have calculated here in our income statement, which is $12,220. And then to that, if we had retained earnings previously that were a profit, so this was a profit. If it was a loss, it would be on the debit side of the trial balance. So there I would add my retained earnings drawdown, and that would be $14,200. So I add these. As I said, if it was a loss, we would have subtracted the loss if it was a loss. And then we would say less our transfers and dividends. And our transfer would be any money that is being transferred, let's say, to general reserves, foreign exchange reserve, etc. So let me just give an example. So general reserves, fixed asset replacement reserve, just put 2. So just put 2. So whatever those figures would have been, there isn't any in this question, so just put 0. So let's say that it was $1,500 for general reserves, and let's say it was $1,300 for fixed asset. So then if you would have had dividends, let's say you had dividends for ordinary shareholders, and let's say this question also had preference shareholders, what you would have done, if let's say the dividends for the ordinary shareholders, let's say the dividends for the ordinary shareholders was $2,500, and let's say the dividends for the preference shareholders was $4,500. So let's say it was those 2 figures. What you would do is you would just say dividends, and you would take the $2,500 for the ordinary shareholders and add the $4,500 for the preference shareholders. And you will write the total dividends. So you wouldn't, like in before, what you would have done, you would have put ordinary dividends paid, and you will put the amount for the ordinary, and you would have normally put then the preference dividend paid, and you will put the amount for the preference. But when you're doing it for publication, you don't separate them, you just add the 2 figures together and just call it dividends, and you put it there, right? So that's what we would do. We would total those, and that would give us the total dividends that were the total amount of dividends and transfer that would have occurred that we need to remove out of this figure here to get what our retained earnings would be to carry forward to the statement of financial position. So then that would be $26,420 minus the $9,800, and then that would give us our retained earnings carried on. So just remember that these are basically fictitious figures here. These figures, all of these figures here are fictitious. The only figures here are real is this net profit here that is after taxation and the retained earnings carried on. But all our other figures that we're looking at here are fictitious because I'm just supposing that you had to do a statement of changes in equity. This is what you would have done. So then also if you had proposed dividends, so remember that proposed dividends is written as a note to this statement here. So if you had proposed dividends, then what you would have done is that you would calculate the proposed dividends for your ordinary shareholders, and you will calculate your proposed dividends for your preference shareholders, and then you will add both of those figures together and just call it proposed dividends. So when you're doing the statement for publication, what we're basically doing is that we are looking at bringing figures together and just showing the public some lump figures. That is basically what we're doing. And because we're preparing it for external usage, so we're lumping everything together. But when we are preparing the statement for internal usage, you would have a breakdown so persons know what was happening there and what would have occurred. Okay, so that's it for this video on the statement of changes in equity. If you were doing it for publication, what you would have done. And in our next video, we are going to be looking at our statement of financial position and how we would prepare that. So thanks for watching, and please like and subscribe to this channel.